As a society, we have peaked. Young people will not be able to afford a house like the one they grew up in. Think about that. If you know what everyone else knows, Matan, you know nothing.
Like, how do you develop such conviction that you can say, well, everybody else is wrong?
What if you drove your car only looking in the rearview mirror? Matan, I guarantee you'll get in an accident.
What is the best business advice you've received?
It's not the strongest of the species that survives, nor the most intelligent. It is the one most adaptable to change. And we all hate to change. But I didn't know what FOMO was until I asked. What is FOMO? So we started doing research on venture capital. This is what we found. And this is key. One.
Hello, everyone. Welcome back to my channel. My name is Matan Hazanov. Today, I'm very excited about the conversation we're about to have with Mr. Neil Nisker. Neil is an exceptional entrepreneur who helped build and sell 3 wealth management and brokerage businesses in Canada. He was investing on behalf of the legendary Sir John Templeton at one point, the godfather of the mutual fund industry. And he now runs and co-founded and runs our family office, which manages about $800 million of some of Canada's wealthiest families. Neil is going to tell us his perspective on investing, portfolio management, what he thinks about the markets today, including the startup market, and how he looks at the VC fund and the VC industry in general. I think if you're an entrepreneur, a VC manager, a startup, you're going to get so much out of this conversation, so stay tuned. Neil, thank you so much for giving us your time today.
Matan, thank you very much for inviting me and including me in your program.
Of course. So take us back. How you started your career? What was your first job? How'd you get into your first business? Let's start there.
The good news is I have a long-term memory because it's quite a long time ago. I've been in the industry for 53 years. I started work when I was 19. I'll give you some context where I come from. I grew up middle class and then perhaps upper middle class. I always had $1 in my pocket. I went to sleepover camp. And I would say I was very, very fortunate to have caring, loving parents who gave me what they can. A dad who worked, a stay-home mom who put her children first. I have an older brother by 3 years and a younger sister by 5. Many, many memories. And as you age, you tend to dwell on, how did you get to this point in life? And in my case, going to sleepover camp, I remember, and I'm almost embarrassed to tell this story, that I actually was in a play when I was 8 years old, and I peed in my pants. I think you're allowed to say this on a podcast.
Yeah.
And no one noticed. I went back at the intermission of the play. I changed into another pair of pants, the same color. But after summer camp, I said to my parents, I was really, really embarrassed, and I felt terrible. And I'd like to, find a way of improving my stage fright. And so they sent me to some classes, drama classes, where I looked to feel comfortable, and it worked. And I've been speaking, debating, public speaking, mostly in America, on subjects that we'll talk about today. But it was a great time for me growing up, having confidence in whether it was my singing, acting, or dancing ability as kids in school plays. And although some of that went by the wayside in high school because I enjoyed playing volleyball and basketball and track and field, and there was always, competition for your time, of course. I went to University of Western Ontario because, that's what people did. You automatically went to university. But I will say that I was quite disappointed because my dream and passion was being creative, and I thought that I would become an architect. And there were only 2 universities in Ontario at the time. And they said, Mr. Nisker, when you come for your interview, bring your portfolio. And I responded, well, what's a portfolio? And they said, your etchings, your drawings, your models, your photographs. And I said, I have none of that. I don't have a portfolio. I'm just very good at math and physics. And I feel that I'm very creative. And they said, well, look, don't even come for your interview because you're not getting in. So I went to Western, took a bunch of general courses, computer science and math and psychology and sociology and English and again, left brain, right brain stuff. And that summer of 1972, I was supposed to work at a summer camp, which I went to as a camper and then, of course, as a counselor, unit head. And unfortunately, it went under. So last minute in May of 72, I had to find a summer job. My dad says, come work for me. And I said, well, I don't want to work for you. Last thing I want to be on earth is a stockbroker. You're a stockbroker. And he says, no, I need someone to work on the floor of the Toronto Stock Exchange. And that experience, being paid, I think, was $50 a week, which was a lot of money to someone earning, like $125 at a summer camp for 8 weeks, was life-changing. And it was a wonderful time. I learned a lot. It was a lot of fun. I was on the floor of the exchange, and I was what's called a phone clerk. And in those days, someone from the office would call you and say, buy 1,000 shares of Bell Telephone. And just for the audience, a lot of symbols were used. So this was Bell Telephone. The old days, you had to do this. This is CP Rail, okay?
For the train.
For the train. And this is 100, this is 1,000, and the right hand is buy, the left hand is sell. So
if you mess that up,
well, you're in trouble if you mess it up. And then there's this error account, which fortunately wasn't used that often. But nonetheless, I had a lot of fun. I was just a puppy. 19 years old. But my dad, who was a stockbroker, was negotiating with 5 individuals. All became famous in their own right, 2 in particular. One named Ira Gluskin, who started Gluskin Chef after he left our firm in 84. And then another Tony Errol, who started Burgundy, which is a money management firm. Nonetheless, here I was, summer job, 19 years old, but I was still living at home, of course. And my dad didn't like to drive as much as I did, so I drove his car. It was an Oldsmobile 88, then an Olds 98, and then finally he said, and it was, I think, 1972, I finally made it. I want to own a Cadillac. And that was, this prestige symbol at the time. And he was able to afford a Cadillac. Bottom line is, I was asked by my father and these 5 individuals who started what was called BBN Institutional. Now, my dad came from Poland when he was 8 years old with nothing. He couldn't speak a word of English. He was self-made. And I know, and I remember in 1962, I was only 10 years old, but I've heard the story so many times, it's like I lived through it, where he had to borrow money and buy half of this little tiny brokerage firm. I think the total cost was $50,000. And those days, that was a ton of money. And nonetheless, Brown Baldwin became Brown Baldwin Nisker. And then Brown died when my father was able to buy in and own half the firm with Bob Baldwin. We then started this institutional department, BBN Institutional. And bottom line is, I was the gopher. So I started in September of 72, not yet 20 years old, and it was gopher. And what a gopher is go for this, go for that. So I did everything that the 5 individuals kind of didn't want to do. And my title was assistant block trader, not gopher, but assistant block trader. And I was reading books that summer, and I read 2 from Sir John Templeton because he was the guru, the Warren Buffett of his day. I started work in September, as I said, and a few weeks later, I actually decided to cold call Sir John Templeton. You see, when the head trader, Ed Pennock, who I'm still in touch with, who's 80 years old, I'm going to be 73 this year, but when Ed Pennock went to lunch or after work, the expression was bending elbows, going to a bar and having a drink of beer, I was kind of the head trader, right? So I took advantage of that. I cold called Sir John Templeton. I'm not sure I got in my first time, but I certainly got through my second time. And a few weeks later, he became a client of the firm. And for 35 years, I spoke to him every week. He was my mentor, became a friend. I entertained for him when he came to Toronto. I introduced him in 1996 to what was the Ontario Prayer Breakfast. I don't know if they still do it. 2,000 people got together. And I sat between the Premier at the time, Premier Harris, and Cardinal Emmett Carter. My introduction for Sir John was 5 minutes. His speech was only 5 minutes as keynote in the breakfast. He had just come back from England the night before. I remember the day very well because I just moved into new office space, starting a new firm after I kind of retired my first time for a day. But it just incredible experiences that I'm very, very grateful for.
Can you maybe speak about Sir John Templeton? What made him so legendary? And like he was a Warren Buffett of that age.
Sir John, grew up in Tennessee as a Presbyterian. He was knighted by Queen Elizabeth for his philanthropy and contribution to mankind. He was, and given credit for being kind of the founder of the mutual fund structure in the late 50s, Templeton Growth Fund, which he launched in Canada, I believe. We didn't do a lot of business with Templeton Growth Fund, but he gave me his time. And time is the most precious commodity we have. I speak at conferences, and I have a few slides that I'll mention a couple of them. The first I start with is, if you know what everyone else knows, Matan, you know nothing.
Mhm.
And Remy de Gourmand said that. I also talk about the fact that, and it's not Darwin who said this, that it's not the strongest of the species that survives, nor the most intelligent. It is the one most adaptable to change. And we all hate to change. So the idea of I am giving back what Sir John taught me. So what did Sir John teach me? He taught me about investing. He taught me to be a contrarian. When everyone's buying, you're selling. And when everyone's selling, you're buying. That you're looking for, and the word he used, quote unquote, is you need to find bargains, like buying wholesale as opposed to retail. You need to find great value. You need to buy at a discount to intrinsic value. And what is intrinsic value? I'll give you an example. Gold today is $3,150. 2 years ago, it was not a hedge against inflation, but it's done extremely well. It's up 19% this year. It's not, it's probably up 75% in the last, 2-3 years. So it's done extremely well. The intrinsic value of gold may be $1,000 an ounce. Okay. It's trading 3 times that. And that is gold used for industrial purposes and jewelry, et cetera, et cetera. Everything else is speculation that it could be a hedge against inflation. There's a lot of fear out there right now. So people are buying gold. So there could be some fundamental reasons, but if a company is worth $10, you don't want to buy it at $10. You want to buy it at $7.50. So that's the important thing about investing, okay? Not follow the herd. And this is what Templeton taught me. And this is why I'm so pleased to be on your podcast, because one of my legacies will be sharing and giving back what I've learned over the last 53 years about investing. And most of that came from Sir John Templeton and my father.
Interesting. So my Pokemon card collection, which is worth a lot on the market, but the inherent value may be even higher. So I did good. Those incredible pieces of cardboard, they make me so happy. So you're 20 years old or turning 20, right? Did you stay in school or did you quit?
No.
Full
So the idea was that I take a year off school. Now, I don't know which one of the 5 individuals said, we need Neil to work for us. We think because we needed a gopher, an assistant. Or my dad said, if you need anybody, maybe ask my son. My older brother, and this is a small part of the story, but big to me. When I got to high school, they said my older brother's name is Jeffrey Nisker. And they said, are you another Jeffrey Nisker? And I said, I don't understand. What's that? Can we expect perfects in 2 maths, physics, and chemistry? I said, what are you talking about? They said, well, your brother gets perfects in 4 of his 5 subjects. I said, no way. I kind of stopped studying, but I took my books home anyways because my parents expected me to have books, and I go up to my room and I, do other things. We certainly didn't have video games, in the late 60s. Nonetheless, I did fine in school, got whatever, an Ontario scholarship. You need an 80 average, I guess. But I wasn't motivated, to become a doctor the way my brother did. And he became a very, very famous doctor and scientist, was Canada's medical ethicist in the decade of the 90s. And what a medical ethicist is what you can and cannot do in a petri dish for cloning. And they just cloned the sheep Dolly in England at that time. And he's still revered as a great brain in Canada, writing many books and plays that are now used to instruct medical students how to become better doctors, compassionate healthcare, et cetera. But I, had this left brain, right brain, quantitative, qualitative, creative on the right side. And I mean, look, when I was 17 years old, I watched a commercial on TV, Uni, Roy, and Al. Well, there were 3 individuals. Uni was a woman and Roy and Al were men. And they stood in T-shirts beside each other, Uniroyal. And Uniroyal made tires. I don't know if they still make tires, Michelin does and Firestone does. But, and so I thought, well, you know what? And I invented a snow tire. I actually took a suction cup to the public school around the corner from where I grew up. I put on the ice and I realized if you create a vacuum, the suction cup doesn't slide on the ice. And I thought, okay. And I did some drawings and nothing came of it. I remember inventing a perfume and a perfume ad in my early 20s. I went to Madison Avenue, New York to try to sell that. And the idea for the younger listeners here, the people under 40 who are creative, entrepreneurism is a wonderful, wonderful life. It's risky. and you're taking chances. And I use the definition of an entrepreneur as someone who puts all his eggs in one basket, and Matan watches that basket very, very carefully. Now, once you're successful, what do you do with your investments in life and business? You diversify. You take less risk. And it's not easy to be a successful entrepreneur. We'll come to venture capital eventually, but the point is that I enjoy these experiences. I enjoyed being creative, and I use that creativity to find investment solutions for the different clients that I had, and I really enjoyed it. I managed money with discretion at a very young age. I should give some context. I was 12 to 15 years younger than all my partners. And we bought my dad's partner out in the 70s, my dad out in the early 80s. And because they were 50-50, we bought my dad down to 10%. And we had 10 partners who each owned 10%. And we were happy with that. And I ran the firm, although I was not allowed to join YPO, Young Presidents Organization, because my family name was on the door. Now, let me back up for a minute. When you're working in a family business, a lot of friends say, you got to go out and get your BA, Bachelor of Arts degree, or Bachelor of Science. And then they say you've got to go out and get your MBA. I'm not going to use the term street smarts, but you learn a lot more about yourself and about life by working, surrounding yourself with people with different skill sets, people who are brighter and have greater experience than you. And that is something that I always did. And I was blessed to have these, 5 partners. As the firm grew, I had more. But I worked twice as hard as anybody else. And that's not just in hours, but in dedication and passion, because I felt I had to prove myself. So there was an insecurity that came with everyone perceiving you were working for your dad. My dad and I were partners. And I discussed in one of our drives homes that, our relationship had changed. It's less father and son as opposed to business partners, because he'd come into my trading room and say, well, son, I just crossed 10,000 shares of Bell Telephone. Cross is when you buy and sell and make double the commissions, which is kind of the goal. And I would then say, well, Dad, I just crossed 300,000 shares of Cadillac Fairview. And so there was a little positive competition, but it did change the dynamic of our relationship. There was always trust, respect, and love and fondness. And he lived to the ripe old age of 97. I was one of his 3 caregivers during COVID. And every day I think about him.
Wow. You became a partner at this firm at a very early age then?
In my late 20s, yes.
In your late 20s, right. So you had to prove yourself for quite a number of years before you were able to become a partner, it sounds like.
Yes, of course. In life, you always have a boss. It could be your spouse. It could be, an employer, and you always answer to somebody. The fact that I had partners and I demonstrated through my hard work, creativity, I hope I demonstrated that I could do things. And I found myself doing deals, corporate finance in those days. I brought the REIT market, or helped bring the REIT market to Canada. It was only in the United States from 1976. We brought it in the fall of 1993 and created the first REIT in Canada. I put companies in play, takeovers. I did a lot of things in corporate finance that were unique, and I made a lot of money for my partners as they made for me. I was president of the company taking over Myra Gluskin in 1984. I was 32 years old. And managing director. I sold the business in 1988 when I was 36 years old. I started a family foundation. We didn't take a lot of money off the table. The reason we sold is my partners who were older wanted to buy a condo in Florida or a cottage in Muskoka. And I was happy. Canada was deregulated. What that means is until 1988, banks could only be in the banking business. And then the government said, you know what, we'll let you go in the brokerage business. So it was called the 4 pillars. And it was banking, brokerage, money management, and insurance. And the government took the pillars down and banks started buying brokerage firms. So it's CIBC Wood Gundy and RBC-DS, Dominion Securities, and Scotia McLeod, which is now Scotia Wealth. And this all happened, from 88 to 1990. They quickly entered the market, and now they're do everything, and everyone has a bank account. And don't get me started on the banks in Canada because I'm not a fan, but they are a necessary evil. But it's I love doing deals. I love being creative. I was 29 when I made my first venture capital investment, and which worked out extremely well. And
what was that in?
Sorry,
what was that in?
So, I wasn't an avid reader as a young man, or in high school. But once I turned 19, 20, I learned something, and I would say, given my past, that's early on. I learned that the more you learn, the more you realize you don't know. And you develop this unquenchable thirst for knowledge. And by reading a lot, that helped me become a better person. And I'm not going to use words like, wisdom or smarter, but it allowed me to see things differently. And every morning I would read a number of newspapers, including the Wall Street Journal. And I read an article in the Wall Street Journal that 6,000 people were dying every day because they were drinking water that was impure. Mm-hmm. Now, I'm drinking from a garden hose in my backyard. We were all drinking from garden hoses, okay? And maybe some of us still are. And I'm saying, well, this is ridiculous. I have to do something about this. And it took me several months, and I found a company, a water purification company, believe it or not, in London, Ontario. And I approached them. I learned about their business very quickly and said, do you need any capital? And they said, as a matter of fact, we're raising $3 million. The company had revenue, okay? So I wouldn't call it seed, okay? I would probably call it maybe a Series A. The company had revenue, losses, and what they had was this ultraviolet technology and patents, and they were building small units for cottage country. And cottages in Ontario would have well waters or lake water. And they would use this ultraviolet technology to sterilize, purify the water. And ultraviolet is the only way, and not through filtering, not through reverse osmosis, it's the only way you can deal with some issues like giardia, for example, which is drinking impure lake water, and 6 months later you get a terrible stomach ache and a whole bunch of other issues. And so Trojan said to me that, well, we're raising $3 million. We've raised $2 million from a venture capital firm, which was part of investment counselor called Butel Goodman. The venture department was called BG Acorn, was the fund. And I said, can I help you raise the other $1 million? They said, sure. And I called a bunch of friends, and I raised about $500,000 for them. And I'm 29 years old, and I put in $25,000. So first rule in venture capital, do not invest more than you're prepared to lose. Mm. It cannot affect your lifestyle, cannot affect your 3 square meals or a roof over your head. So I invested $25,000 and approached some friends who put in $25,000. And I approached some very wealthy families that may have been worth $100 million. And they said they're putting in $50,000. And I said, wait a minute, you're worth 1,000 times, 10,000 times what I'm worth. Why are you only putting 50? He says, because we're not going to worry about this investment because you're going to watch it for me. Anyways, bottom line is, and this is like 1981, bottom line is Trojan went on to become the best investment that I've ever made. It was like a 75 bagger, which means 75 times your money. I put some in each of my 4 children's names over time. And that day, when I was 29, I had 1 child. But we helped take them public about 15 years later. I put them in play and helped take them private 10 years after that. Because if they missed a quarter when you're a public company, you need to deliver what the street is expecting. It was taken over by a company called Danaher, which is a large U.S. conglomerate. Trojan Technologies today, as a subsidiary of Danaher, is purifying drinking water and effluent for around 3 billion people. They do New York City, they do Seattle, Washington, and they have a huge business in China.
This company from London, Ontario.
A little company from London, Ontario that I was fortunate to read this article. And again, what motivated me to invest is that this article that 6,000 people were dying because they were drinking dirty water. And here in Ontario, we take, in Canada, North America, now in most places in the world, we take it for granted that we have the access to clean water. And it turned out to be not just a socially responsible investment or, ESG or impact because we've saved hundreds of thousands of lives, but it was the best investment I've ever made.
And that's pretty incredible. 75x return in 15 years is not bad at all. So you mentioned a little bit that your other partners wanted, a vacation home in Miami or Muskoka. But truly, why did you sell? Why did you decide to exit that business?
Again, when you're one of 10 partners, it's not why I sold.
Right,
Okay,
the collective.
everything is done a consensus. We were all on a board of directors. We all made decisions together, and I would plead a case. And so basically, a couple firms approached us. We decided to negotiate with Hong Kong Shanghai Bank. Their head office was in London, England. They started in Hong Kong, obviously, and they wanted a foothold in Canada. And this is different than a Canadian bank. And don't forget, we were the smallest brokerage firm, one of them, smallest brokerage firm in Canada, even at that time. And it wasn't we were selling to take a lot of money out. We were selling to build a business, and continue to have cash flow and do well and build the value. But it didn't work. Selling to banks, they changed the culture of the firm. But I enjoyed going to England every 6 weeks to negotiate. But it did become HSBC Securities, and honestly, they ruined the firm, and they don't even exist today anymore. But nonetheless, I think Royal Bank bought HSBC Canada. But I enjoyed going. They sent me around the world. Said now we have a foothold in Canada. Neil is the economist. Neil is the portfolio manager. Neil is the stockbroker. And Neil is the, because I could talk about different things. Although I'm probably not an expert in anything, I certainly enjoyed the travel around the world for a few weeks. Australia, Japan, Hong Kong, China. But it was an interesting experience, and I stayed for a while. I took myself out of management. I focused on managing money. 2 years after we sold, Sir John Templeton, after 18 years of mentoring me, said, Neil, can I ask you a question? I said, well, of course. And this is my weekly call with him. He says, would you consider managing some of my personal money? I said, sorry, can you please repeat the question? I almost fell off my chair. He said, would you manage some of my personal money? And I said, of course. And this was obviously the teacher testing the student. And he says, there are conditions. You'll be one of 3 managers in the world who manages this money for me. I'm going to start you off with $3 million US. I'll judge you after 5 years and see how you do. And so I was one of 3 managers. It eventually was, I think, 5 over the next decade that managed this particular fund that Sir John started with some, not all of his liquidity, because he had obviously a lot of money invested in the Templeton Growth Fund and other Templeton strategies and products. And he did mentor another Canadian, Prem Watsa, who started at Fairfax Financial, and Hamlin Watsa, the investment counseling firm. And I bumped into Prem a couple times in Nassau because I would try to see Sir John once a year in Toronto, and once a year I'd go to Lifer Key where he lived in Nassau when he went offshore. But nonetheless, I will say about Sir John that, and there's many good books to read, The Templeton Way and Sir John's 10 Rules of Investing, and I certainly would recommend that, and I have other books to recommend as well. But the point being that Sir John was a fascinating thinker. He was very confident. He was very disciplined to investment strategies and processes, and that's what I took away with him, as well as many other things. He died, I think, in 2008. And Prem called me up and said, there's a difference between Prem and I. Prem called me up and said, how are you getting Sir John's funeral? And I said, I haven't even thought about it yet. He says, why don't you, come with me on my private plane? I don't have a private plane. I did discover philanthropy, tzedakah, at an early age. I started my own family foundation when I was 36, and just with $150,000. So you don't have to be a multimillionaire to have a foundation to leave the world a better place than you found it and do good while you're alive. Too many people might do good after they're gone for tax reasons. I think you should enjoy the opportunity of being pleased with the blessings being bestowed upon you and giving back. But Sir John, taught me a lot, and I think about him every day, and we can talk about that in a few moments about how I'm using what he taught me in my new firm.
Yes, of course. I'm just curious, how did you do with that $3 million that he gave you after 5 years?
Well, I'm embarrassed to say that was 1990. He decided after 4 years. One of the criteria I want to mention before we move on is he said, Neil, you're limited to 10 stocks. And I said, but Sir John, that is too risky. You're too concentrated. And he said, no, remember, I told you you'd be one of 3 managers, and they also are limited to 10 stocks. So I will have a 30 stock portfolio that's global. You focus on what you think you're good at, and that is, Canadian and U.S. small mid caps, and they'll do their thing. But after 4 years, he gave me another $4 million US, and that's $7 million US ended up becoming $27 million Canadian because I report in Canadian funds. And once in a while, I look at my file where I see their marketing brochure materials. It was called Best Investments. We closed the fund in 2000 because he and his friends decided they didn't buy any .coms because that's not the Templeton way. You're wanting to buy value, and there was so much froth and overpricing in the market. Similar characteristics that went on until about 6 months ago. And we've seen obviously a correction in the Magnificent Seven, et cetera. But bottom line is it was an amazing 10 years managing his personal money and brought us closer together. And because I just kept asking questions. And that is one of the takeaways in life is advocate for yourself, ask a lot of questions, take some chances. And here's what Sir John taught me, and maybe it's one of the most important things. We used to debate for a number of years. It's not how much you make, it's how you keep from losing. So think about this. If you never have a losing investment in your life, you'd be the greatest portfolio manager in the world. We all have losses, how to limit them. We have buying rules. You should have selling rules, which is perhaps another opportunity for a podcast. But the point being that the concept of not losing, he taught me to focus on not what can go right, but spend more time on what can go wrong. Okay? See, the way the brain works is no one makes an investment to lose money. No one starts a business to lose money. We have biases. Sometimes it's bias of overconfidence. Sometimes it's recency bias.
Sounds like you've never invested in startups. These guys start businesses to lose money.
No. The goal is not to always lose money. The goal is to be very, very successful. And I'll come back to that when we focus on venture capital, about understanding why you're doing things and the kinds of businesses you should start. But really, if you ask a portfolio manager today, now I'm a reformed portfolio manager. I managed money for 35 of my kind of 53 years. Next month's my anniversary. I'm in my 6th decade, if you will, okay, of this industry. The idea simply of not losing, the idea of as a portfolio manager, why do I think my 10 stocks for Sir John? Oh, by the way, I debated with him because a number of his friends through his bank opened up accounts that I managed their money as well, and I would have 20 stocks for them because I thought that was the optimal number of positions to have, which decreases the volatility and could improve your chances of return, not necessarily. And I debated with him about a year after he said 10 stocks that we should go to 20. And I won. I won. Because in the second tranche of money that came 4 years later, he says, Neil, okay, you don't have to manage, you don't have to only own 10 stocks anymore. You can go to 15. I only half won my argument. I went to 15 stocks. But I will say that it was a marvelous journey. I'm blessed to have met him, know him, and be able to give back what he taught me.
So you mentioned, first of all, one of the most surprising things about this relationship is that cold calling worked. That's incredible for the people out there, cold
If
calling.
you don't ask, you don't get, right?
Right, exactly. So you mentioned quite a few nuggets of wisdom there, but a lot of it sounds somewhat obvious to thinking in hindsight. Like, obviously you want to invest in companies at below their inherent value so that you can profit. But that's much easier said than done. Like, usually, I think this is incorrect to a certain extent. It's kind of perfect market hypothesis that the entire market represents all the information and everything's priced at perfect supply and demand. Of course, that's not true because people have information that they probably shouldn't have, and people use emotions, and there's a whole bunch of other things going on. But how do you determine whether or not the inherent value is different? Like, you would have to assume that the entire aggregate of the market is incorrect, right? So that requires, that's the question. Like, how do you develop such conviction that you can say, well, everybody else is wrong?
So that's the discipline, and that's what contrarianism is all about. And it's not easy. People, again, I don't come up with these expressions, and I have to be educated at my age, but I didn't know what FOMO was until I asked. What is FOMO? Fear of missing out. So what happened in 1999, where I actually sold a business that I started 3 years earlier, because I never bought .coms. And although a lot of money came in and we were doing well, in 1999, clients started to leave because I wouldn't buy .com. Templeton taught me to be very disciplined to a strategy. You don't want to have your money managed by someone whose style changes, shifts, creeps. And for example, if you're investing in a growth manager and growth is not in this particular season, and he says, I'm becoming a value manager. Now, the reason you're investing with that person is because of his long-term track record. Okay. So if someone shifts their style, that's a reason to leave. Templeton also taught me, again, I'm sharing these tidbits and not in any order necessarily, and I'm sorry if I'm jumping around, that it takes, Neil, he says it takes 4 years to get a 4-year track record. Wait for 4 years before you decide. And, do your research, do your due diligence. This could be, it was particular to a style or a manager. And I realized that I felt that was too long. And Templeton and I debated a lot. And I said, Sir John, I think it should be 3 years to have a 3-year track record. And that's one of the principles we use today in business. And I said, the reason is if you find a great manager with a wonderful 3-year track record, there's an opportunity cost of missing that 4th-year return. Now, I finally got him to concede. So part of our family office, my new firm that I came out of retirement to start 7.5 years ago, has that as one of their principles, okay? Anytime, and I get 50 emails a morning from managers all around the world, if it says new, okay, I don't respond to anything, it goes in my garbage bin. If there's something that's interesting, one of my partners shows me, I say, just respond if it's 1 year old to say, call us in 2 years when you have a 3-year track record, right? But again, I'm not sure I'm answering that specific question, but if you ask a manager today why their portfolio will outperform their benchmark or the index, the market, they're going to give you a whole bunch of gobbledygook that you will accept. And that gobbledygook is low PE ratio, price earnings ratio, low price to book, high return on invested capital, ROIC. Okay. We have a moat around that particular company. Okay. Where competition will be weak. We have great management, and all that, excuse my language, is bullshit. The single reason why they think that portfolio of 20, 30 stocks, perhaps more, will outperform their benchmark is because they're babies. They pick those stocks. And it's not necessarily hubris. It's that bias and overconfidence that I pick those stocks, so they have to outperform. And that's what people don't realize, which brings me to another book that people should read, and that's called Thinking Fast and Slow by Daniel Kahneman, who has won a Nobel Prize with his partner Tversky posthumously because he passed away before Nobel Society recognized them both. And Daniel Kahneman speaks about behavioral economics or behavioral finance, why we make decisions where we hate to lose more than we like to win. And I'll just mention for a moment, that's my gambling philosophy. I don't gamble. I'll go to Vegas every 10 years. I'll watch some shows and dine in some good restaurants. I like watching people gamble, but because my philosophy in gambling is the same as investing. I just hate to lose much more than I like to win. There are reasons to sell losers. Okay, there are reasons to sell winners. I like to let winners run. However, if it gets to the point where I feel that a stock is now fully priced, my pension funds clients would hold on to cyclical stocks. So International Nickel Inco or Stelco, these are stocks that go from $10 to $20 to $10 to $20 to $10 to $20. And when they were $10, they had no earnings, okay? And they were trading at half of book value because book value was 20. And so I said to these institutions, you have to sell when it gets to 20. Well, say, Neil, we bought some at 10. I can't sell at 20. I said, you've doubled your money. And that's all it's worth. He says, yeah, but it's trading at book value and it's 6 times earnings. I said, but the earnings are cyclical. They're going to lose money in the next few years. You have to sell. And I finally came up with selling strategies. We all have buying strategies. You need to have a selling strategy. When you think something is fully priced, sell 10% of that stock and sell 10% every 10% it goes up. So you're not fully out since you've doubled your money again, and your average out is 50% higher than when you thought it was fully priced. Now, if the stock is cyclical and goes down, guess what? You can always buy back what you sold. You have to figure in the capital gains tax that you paid when you sold, but you want to buy back at a discount on a net basis. Oh, and by the way, we manage money on a net basis. What is net? After fee and after tax, because at the end of the day, that's all you eat. Okay.
So I'm still struggling with this idea of inherent value, because you gave a great example of gold earlier on. The inherent value from your perspective is that what is someone willing to buy it to use it in some useful capacity, like manufacturing, for example, right? There's another philosophy out there that inherent value is what someone's willing to pay for it, right? So I'm curious, like, let's say you take a stock, right? Because it represents assets and earnings and all that. The inherent value, at least from that point of view, is that it's worth whatever the market says it's worth, because that's what you would have to dish out to buy it. And so if you're buying it on the premise that I know something the market doesn't, you're saying either one of a couple of things. One is that the market is wrong, or that I have some insight into the future, and therefore, something is going to happen that people don't know about that will make the price go up.
So I've been writing about this. Every quarter I write, it's on our website, about the state of the world and global macro events. I find the world a much more dangerous place today than it's been in the past. The market is the market, and you don't fight the tape is an expression we all grew up with, those of us who have been in the industry for a while. That doesn't mean you know anything about the market. It doesn't mean that you know how high a stock price will go. But, Tesla will double, triple, and then it'll be cut in half.
Mm-hmm.
One of the things we haven't talked about and what we focus on in my new business is risk volatility, because behavioral economics suggests that people make the wrong decisions. They'll chase the .coms because there's a fear of missing out, and look at all the money my friends are making. Well, they talk about the one or two stocks that they've doubled their money on. They don't talk about the 10 stocks that they lost a lot of money on, right? People don't brag about the stocks they're losing money on. So, Matan, what I'm saying is that the market is the market. We know nothing, okay? We know nothing. You come up with an investment philosophy that works for you, okay? Remember, I said it's not how much you make, it's how you keep from losing. You decide how much risk you're prepared to take. Venture capital, for example, I'm 29 years old. I developed this rule that says you do not invest more than 10% of your liquidity in venture capital. Why? Because you could lose it all. Well, you're not going to lose all your money investing in the S&P 500. It'll go up, it'll go down. There are times when it goes up. People remember the good times, okay? And there's this fear of not participating, okay, and creating wealth. They forget the bad times. Now, you can go back 120 years in the stock market, and it's delivered a 9.3% return. That is not net of inflation. So that's not your real return, which would be net of inflation. That is a good return. The last 10 years, it's 12%. We have capital market assumptions with a view of what's it going to do in the next 5 years, and we say 6.5% because we think we're in for some rough times. The market's already demonstrated that in the first quarter. Goldman Sachs, one of the largest money management firms in the world and brokerage firms, says the market over the next 10 years will only give you 3%. So the question is, how much risk do you want to take to earn 3%? I'd rather take a little more than market risk and invest in venture capital where I can go do 30% plus. So these are the things you consider, but there's no hard and fast rules for when to sell a stock or when to buy a stock. And I'm not saying it's guesswork. There's more gambling in the stock market today than in my 53-year history. And that is because young people, many of the listeners on this podcast or viewers, will not be able to afford a house like the one they grew up in. Think about that. As a society, we have peaked. Okay, the baby boomer generation that I am part of, okay, has a better lifestyle unless you include trust funds and inheritance. And yeah, there'll be $10 trillion invested in Canada in the next, 10, 20 years. A lot of that money that's already started to pass down has gone into real estate, and real estate prices are crazy, although they probably will come down. Certainly the condo market has corrected and will continue to correct. But the bottom line is there's no hard and fast rules. You find something that works for you, your situation, your state of mind in terms of, can I deal with a loss? I will say one thing, that this is something Kahneman talks about, but Templeton taught me as well. When a market goes down 10%, it's called a correction. And when a market corrects, people say, you know what? This happens from time to time. I'm a long-term investor. I'm going to wait it out. Okay. When the market goes down 20%, it's the beginning of a bear market. And most investors will say, you know what? I'm a long-term investor. Okay. I'm not happy it's down 20%. Maybe I should have sold when it was down 10 or even when it wasn't down. But I'm a long-term investor. And they start justifying, rationalizing their position. It becomes a bias. When it's down 30%, and this does happen. It happened in 2000, happened in 2008. It also happened during COVID 2020, and it happened in 2022, okay, for a period of time. When the market's down 30%, okay, you start to hear people say, you know what, I can't take stocks. I can't own stocks. My disposition doesn't allow me. I'm not comfortable. I'm not sleeping at night. It's affecting my health. I'm going to sell. And that's the beginning of this term capitulation. And Templeton taught me that's when you find the best bargains. That's when you buy, okay, when everyone is selling. So if your barber, okay, or people still get shoe shines, a shoe shine salesman, okay, says, you know what, you got to put money in the market. I just bought this stock. I just bought NVIDIA, or I bought Tesla. When they're talking about putting their money in the stock market, it's time to sell. Mm-hmm. Okay, so the contrarian sells when everyone else is buying and buys when everyone else sells, and we're not buying yet. The last time we bought there was some capitulation in May of 2022, and we bought some more equities. But right now we are underweighted equities because there's so many asset classes out there, like venture capital, that we're just going into for the very first time. Mm-hmm. Not for me personally. I still have some venture capital left over from 12 years ago, 15 years ago, because I started to help start two venture capital funds back in the early 90s, mm-hmm. Which I have fond memories about.
So tell us about why you eventually started our family office. You went out of retirement to start it, so that's fairly interesting. So tell us why you did that. I'm
going to take you back to the first time I retired for a few days, and I was working on this before I retired, and I retired my portfolio management license with the Toronto Stock Exchange because I was a director and owner of a brokerage firm. I could become a portfolio manager with discretion, and that's what a portfolio manager has, discretion. So I decided that higher on the food chain is being a portfolio manager. In those days, it was called Investment Counsel Portfolio Manager with the Ontario Securities Commission. So in my early 40s, I started a firm. I had a number of families back me, wanted to own equity in the firm. And that firm was sold 3 years later to a firm called YMG in 2000 because I had to lengthen the runway because we wouldn't buy .coms. And although $150 million came in the first year without me making, I'm embarrassed to say, an outgoing phone call, half that money left in 1999 because I wouldn't buy .coms. Now, the people who left me to buy .coms suffered in the next 2 years. I went with a firm called YMG. All my investors got their money back, and YMG was a public company, yield management group, and I created a private wealth platform for them, and minimum $1 million, then $2 million, then $5 million, et cetera. And that company was sold in 2006 to a company called Fiera Capital, which is now managing about $180 billion, and I retired in 2014. Not being able to sit still, fancying that I'm still an entrepreneur, if I want to use that word, I started writing a business plan, and it took me 4 years to put our family office together, my next venture, if you will. The first 3 firms were sold, and I delighted in my lifestyle. I delighted having a foundation, giving money away, and I created with my partner Tim Sesnick, who writes a tax column in the Globe and Mail every week for 28 years now. We created our family office, generic name. The logo is a circle, which represents continuity. Now, as I mentioned earlier, I speak at these conferences in the United States, mostly Canada as well. And this month, actually, in 3 weeks, I'll be in New York speaking about our investment philosophy and process and how to make better risk-adjusted returns. So how to make the same money for a third of the risk, or how to make more money with the same risk. And I enjoy giving that talk, some of which I've touched on in this podcast. So writing this business plan, meeting Tim a few years later. As I said, it took me 4 years. Tim and I dated to make sure that we would be good partners. When I mean dated, we had meetings together. We did due diligence on each other. We had references for each other to check out. We had spouses that I'm divorced. I was in a relationship at the time that checked each other's out. We went out. We did psychological evaluations. Now, think about this. When you bring in a partner, the due diligence you do on a partner should be much greater than making an investment or giving money to a portfolio manager. This is your next business venture. It's important that you have no concerns. It's important you share values. And everything was great. And Tim and I are wonderful partners almost 8 years later now. The bottom line is, speaking at these conferences in the United States, I realize that there's something that's being done for ultra high net worth families. I got to be friendly with people like the Vanderbilt's Biltmore Family Office, the Rockefeller Family Office. Market Street Trust is the name of the Houghton family's family office. You've never heard of the Houghton family, but you know their product. It's 150 years old. In the United States, family offices have been around for 150 years old. Corning Glass is the Houghton family's product from Ithaca, New York. And I'm saying, why don't we have these strategies in Canada? And I hired a consultant to find me the right partner in the United States to launch this business, because I wanted state-of-the-art IT, state-of-the-art back office systems, state-of-the-art introduction to some of the best managers in the world. And I interviewed 20 on my own, these families that I met, but didn't find the right partner. And then I hired a gentleman named Jamie McLaughlin, who introduced me to another 20, and we found a firm in Boston called Ballantyne, and had a formal relationship with them for the first few years. The idea of why ultra high net worth families don't have these services, I said, ultra high net worth Canadian families deserve these services. Now, ultra high net worth is defined as a net worth of 30 million US plus. So let's say, rounding with exchange rates, 45 to 50 million Canadian. And that's the pond that we swim in. That's what we're looking for. Now, I'd like to help 1 million people, 10,000 people. I hope to really help 100 ultra high net worth families. We have 43 right now. We're advising on some 4 billion, more than 4 billion, of families with assets, but we only have discretion on the 800 million that you mentioned at the beginning of this podcast. And that obviously number grows, every month or so. Because as we're doing planning services, we have a tax department I'd put up against any of the big four. We have obviously an investment department that I'm the CIO, Chief Investment Officer of. I created with Tim a new governance model, because although I've helped build 3 businesses previously, this one that I'm helping to build does not get sold. I want the grandchildren we're serving today to be with the firm when they're grandparents. How do I entrench that? How do I make this firm sustainable? And I created a new governance model that no one's ever heard of. We are owned by our clients. 50% of the firm is owned by our families. Not all of them, but most of them. And that means that we answer to a board of directors, representing our families, family members, clients, and we have to be lily white. We have them looking over our shoulder. They expect dividends. We watch our costs. And I've never had more fun. I've never been more passionate about the business, this particular business, than my other ones. And I started as a senior citizen. So as I say, I'm having more fun.
You also mentioned to me at a different time that part of what you try to solve for these families, or at least help them with, is succession planning. I don't know if you saw the Succession, but it's a bit of
yes, yeah, great example. Great example
of what not to do, perhaps. How do you help? Because it's very hard for someone that's maybe not ultra high net worth, how much problems money can bring to a family, right? I hope I never have those problems, but it's a problem that people don't realize exists. So how do you help with that? And what kind of issues do you see? What kind of advice do you have for these families?
It's a great question. And I'll be honest, probably the most important question you've asked today. So the lessons for families of wealth are really no different than the lessons for families without wealth. So it doesn't matter if your children are going to inherit $100,000 or $100 million, okay? It's about transparency, communication, opening the kimono, making them aware, bringing them on side, and at different ages. So we, have families of 3 generations. We're educating the 3 generations. So it could be a spouse who wants to learn about venture capital. We've done a couple seminars in the last week on that. We do podcasts for our clients and friends about philanthropy,
which we will link to down below.
Thank you. And these are on our website. We've done it philanthropy. We've done it on values. We've done it on psychological issues of family of wealth. We're focusing on a particular niche because, people said, Nisker, as a senior citizen, if you don't need the money, why did you start this business? And I said, this is my last kick at the can. Okay. Um, and I hope to be in this business when I'm 100 years old and still playing tennis and golf. Okay. Um, that's 27 years from now. But the idea is I can influence, our family office can help influence $1 billion of philanthropy.
Uh,
Okay. Helping families, it's one of our values, leave the world a better place than you found it. And as I said earlier, the world's a mess right now. It's upside down, it's dangerous, and you have to be careful with your investment portfolio. There will be great opportunities in the future, and that future could start soon. But the idea of helping families, there's a cliche, well-worn expression called shirt sleeves to shirt sleeves in 3 generations. Now, we want to prove that wrong. Where that comes from is the first generation makes the money, the second spends it, and the third loses it. Okay? Now, there's also dilution because you'll have a few kids, and they may have a few kids, and they may have a few kids. So there's many, many mouth to feed over 3 generations. So you have to continue to earn a great risk-adjusted return in your investment portfolio. But that's what we're trying to do here. We're trying to educate families we serve and anyone who will listen to us on best practices on how to communicate with your children. There are patriarchs and matriarchs who want to rule from the grave. And then you have others who share information. We had a family that the children could be in their 40s and think the family's worth 20 million. Well, the family wouldn't open the kimono and talk about it. And so we suggested that, you tell, your 2 daughters that about what happens if you both get hit by a bus tomorrow, God forbid, 1,000,000 times? Like, what happens? And so you need to have a continuity plan. You need to have a sustainable plan. You need to understand what the taxes are, okay? Because money goes tax-free from spouse to spouse, but intergenerationally, you have to pay capital gains tax. Now, if something, God forbid, happens, and all of a sudden you have to pay $1 million in tax, or 20 million in tax, or 50 million in tax, they have to sell maybe apartment buildings. They have to sell the family business. Well, that's not so easy to do. Those are illiquid assets. So, we often use insurance as a tool to help. So there are lots of different things, but what's motivating us is all of this wealth, okay? At the end of the day, there's only 3 things you do with it, okay? You can't take it with you. There are no Brinks trucks in funeral processions. There are no pockets and shrouds. You cannot take it with you, okay? You will spend it during your lifetime, and if you have excess capital and liquidity, you're not going to spend it all. Then you'll give it to your children. But again, how much is enough? And then you have societal capital, which is, I'm going to leave some money to charities. That also saves taxes. So it's a win-win situation. And when you put that all together, that's what our family office does. Mm-hmm. It's a family office. Many brokers firms and banks are using the expression because it's a right-leaning expression. Okay. I mean, if you remember, stockbrokers were around in the 20s, and then in the 80s, they became, then it became investment advisors. Okay, and that was a right-leaning term, feels better than the word stockbroker. And then it became a wealth advisor. Whoa, well, that's nice. It's more than just money. It could be happiness. It could be friendships. A wealth of family members and friends. And then now it's become a family office. And I speak at conferences. How many people call themselves family offices? And then I tell them the 6 different legs to our very solid table. And then I say again, how many people in the room do all 6 of those things? And of course, no hands go up. So, but I love the fact that the pie is getting larger and people Google family office, and we don't advertise, we don't market, it's all word of mouth. And it's been a lot of fun and fabulously successful. So I'm very, very pleased.
Right now, I'm curious, you also mentioned that you're looking into venture capital for the first time as part of your mix of assets on behalf of the families you invest for. What did you think about venture capital? Why your perspective changed today?
Great question, because it's unique. Most people aren't in venture capital, and for a lot of reasons. It's the riskiest asset class, slightly more than stocks. So I need to give some context. On behalf of our families, we don't take a lot of risk. And we're beating what our benchmark is a 60-40 portfolio, because many clients come to us with a 60-40 portfolio. And this is what the banks run. 60-40 portfolio, quite simply, is 60% stocks. It could be Canadian or S&P 500, and 40% government bonds, a bond index. And those are 2 asset classes. We have 13 asset classes, now 14 with venture capital. We have 20 investment managers in 22 different strategies, because we have 2 managers that each have 2 strategies. So we are widely diversified. And because we focus on risk, not return, again, I don't want this to become a cliche, but we are in the stay rich business, not get rich business. Okay? When you have 50 million plus, you can't spend the income in your lifetime. I mean, you probably could. But we believe that, if we can make you 7-8%, double your money in 9 years, 10 years, that should sustain any lifestyle. And then you have money for family to leave, or, for charities, et cetera. The standard deviation, okay, is a measurement of volatility and risk. And our standard deviation is less than half of government bonds and less than a quarter of the stock market.
Wow.
So on our 800 million, which is measured from day one, okay, it takes us around 9 months, maybe a year, to invest our family's liquidity that's given to us to manage on a discretionary basis, although we never take discretion, okay? Our standard deviation volatility risk is 2 to 4%. Bonds are 6 to 7, 8. Stocks, it can be 16, 18% volatility because they go like this. Last 2 years, the volatility is less because the market's gone straight up, right? Mm-hmm. So I said to my team a year ago, we need to increase the risk of the portfolio. I said to the clients who understand our philosophy and signed up. And by the way, I will not take a client who doesn't understand our investment philosophy of stay rich, not get rich, and focusing on risk. Very particular. We're not going to buy Bitcoin because 2 reasons. 1, what's the intrinsic value of Bitcoin? And 2,
I need all the trolls commenting on that.
But I need a capital market assumption, okay, to which to build a portfolio and do our asset allocation strategically, okay? And I don't know where Bitcoin's going to be 5 years from now. It could be 100,000, it could be 200,000, it could be 20,000, right? So because I don't want to lose money and I don't want to see volatility in our portfolio, I don't own Bitcoin. I don't own gold because it's trading at a premium to intrinsic value. And again, I don't have a capital market assumption for where gold is. You see, people rely too much on the past. You need an opinion of the future, okay? There are these expressions, forget the past, plan for the future, but be present, right? And right now I'm being present. I'm thinking about the past. I'm sharing things that I've learned and things I'm planning for the future. But right now I'm focusing on answering your questions as succinctly and fully as I can. But the bottom line is, I said to the team, there is an asset class. We think equities are overpriced. That was the right call, by the end of 2024, because the market's gone down. And so we haven't bought any equities recently. And again, for a new client that comes in, we will buy them the minimum position. Because when you're doing an investment policy statement, IPS, you have a minimum, you have max, and then you have a policy, a target for 5 years. So I said, I am familiar with an asset class, venture capital. I've been in it since I was 29 years old. I've had some luck, but I also have the scars. 60, 70% of your venture capital investments will go to zero. Mm-hmm. So we started doing 6 months ago due diligence. Now, when we do due diligence on a manager in an asset class, it could be a second manager in the same asset class. We will spend roughly 50 hours and we'll have executive summaries that can range from 15 to 25 pages. And that's the executive summary. Wow. And we have hundreds and hundreds of pages of due diligence. So we decided to first look at the asset class and does it meet our criteria? And one of the things I've come up with, and this is over a decade ago, was I found 3 flaws in the Sharpe Ratio. So I'm going to digress for a minute only. And for people listening to the call, the Sharpe Ratio, and William Sharpe won a Nobel Prize in the early part of the decade of 2000 for being the first to recognize the relationship between risk and return. And the Sharpe Ratio, very simply, is take your historic return minus the risk-free rate of return and divide it by the risk you take, the standard deviation, volatility, to earn that return. And you get one number. And the 3 flaws, very simply, and I talk about this when I speak publicly, the 3 flaws are very simply that you're only looking backwards, okay, at someone's return. And I don't think that's very meaningful. It's a good guide post, and you should know someone's past history. Remember I said it takes 3 years to get a 3-year track record? But I use the analogy, what if you drove your car only looking in the rearview mirror? Matan, I guarantee you'll get in an accident, right? And that's what only looking at the Sharpe Ratio does. Second flaw was, what is the risk-free rate of return? And if we were sitting around a boardroom table with 12 chairs, I would probably get 8, 9 different answers. Is it LIBOR? Is it SOFR? Is it T-bills?
Yeah.
Is it treasury bonds? Is it overnight? Is it 30 days? No one knows, because that's the subtrahend in the equation, and all you see is the quotient, the final number.
Mm-hmm.
And then the last flaw is simply, if that manager has not lived through one in 100-year event, what's called a fat tail or black swan, you have no idea how that strategy is going to perform when one happens. And I do have a chart that I share in my talk, and I quote Rosanna Dana from Saturday Night Live, the late Gilda Radner, who said, it just goes to show it's always something. And every year there's a 1 in 100-year event, okay? Last year Florida had 2 Category 4 hurricanes within 30 days of each other. So a lot of crazy things happen in the world. Again, you're an investor. How do you protect your portfolio from this? So we started doing research on venture capital. And for those listeners who are interested in venture capital, this is what we found. And this is key. And again, you will find some of this on our website. 1, don't even visit the asset class. Don't invest a penny unless you find a top decile manager. And a top decile manager is simply one manager who's better than 90% of his peers. A bottom decile manager is worse than 90% of his peers. Top quartile is better than 75% of your peers. So you need to find a top decile manager. That's not so easy. Number 2, you must be early in. First stage, okay? They do the best. And I'm just going to give you an example of that. We're with a manager now. He invests $100,000 in a company with $1 million valuation, seed money. A year later, the company raises at a $5 million valuation. You've already made 5 times your money. Now, you don't have liquidity, but the valuation has gone up 5 times. And that's how you earn a top decile return. The third point, the manager must be small. He must manage less than $250 million. They're mostly U.S. funds in assets. The manager under $250 million does much better than a manager who's managing $500 million, who does much better than a manager managing $1 billion. They can't be nimble. They can't buy the early stage or small companies. The bigger funds have to put 10 million in, 20 million in for it to move the needle. And we were fortunate.
And this is in the aggregate or in each individual fund when you say 250?
Well, this is generally when you look at PitchBook or Preqin data and go back 100 years, and then you have to compare vintage to vintage. Mm-hmm. Now, for those listeners who don't know what a vintage is a year that they raised money. And that allows you, so you could have a vintage 2018, and then 2 years later, they're raising a new fund, and that's 2020, and then they're raising a third fund. So that's a vintage. And you need to compare apples and apples because the economic situation, the valuation trends are different. Okay? So the apples to apples comparisons are paramount. And we were fortunate to find a couple managers that are top percentile, and I will keep that as a secret sauce. And those managers have been performed very, very well. One's raising their second fund, one's raising their 6th fund, and we've committed about $10 million each, US. We're just sticking our toe in the water because this is the riskiest asset class. Now, let me come back to standard deviation. If I said the stock market has a historic 16 to 18% risk, okay, venture capital might have a 22 to 24% volatility risk.
When you use percentages in this context, what does that percentage mean? Is that like the discount rate you would use, or
no? That is the probability. It's your cosine. It's your probability of being 3 standard deviations away.
I see.
Okay. Your fat tail black swan. So it's the volatility of very low volatility is when something goes straight up or straight down. Higher volatility is when something goes up, goes down, goes up, goes down, goes up a lot, goes down a lot, goes up a lot, goes down a lot. We have a number of what I call watching paint dry. Do you know how boring, Matan, it is to watch paint dry? You know, it goes on a little darker, dries a little lighter, a couple hours later. So we invest in some credit strategies and mortgage strategies. So when I talk about a low volatility strategy, if you get 50 basis points, 0.5%, every single month for the last 17 years with a top up at the end of the year. What's your volatility? Non-existent, like cash. So we love those strategies because that becomes a foundation for a portfolio. Again, remember I said I want to double your money every 9 or 10 years. That's a 7 to 8% compound return. Okay, I need strategies earning 6, 7, 8, 9, 10%. Okay, to be a foundation. Then I could take more risk with strategies that earn 30%, and that's our target. Earlier I mentioned 6% is our target for equities. I'm going to take slightly more volatility, maybe 20% more risk, but I'm going to get a return, in our opinion, of 5 times that. Our target is 30% over the next 10 years for this asset, for our manager, okay? Our asset class target is 12.5% return, okay? But no, sorry, our asset for venture capital, it's about 20%, about the same as the volatility we take. But the managers we're investing in have been delivering historically 50%. Remember, I mentioned top percentile. So we search the world for the best managers. Once we find an asset class where, I'm going to come back to the Sharpe Ratio for a moment and the flaws I found. I created a new ratio a number of years ago when I was at Fiera, and I've named it and trademarked the Simple Investment Ratio. Now think of the first letters of those 3 words, Simple Investment Ratio. For those good guessers, yes, I named it after my mentor and friend, Sir John Templeton, and it's called the Sir Ratio, and Sir Ratio has been trademarked. And every day we use the Sir Ratio, so I get to think about them every day. And what the Sir Ratio does, and for every listener, you should look at your own portfolio, and this will help you tremendously. Look at the risk you've taken of each of your asset classes. Stocks, 18%, bonds, 7%, multiplied times how much money you had, the return that you had in each of those asset classes. So if you had 10% return in stocks, okay, times 60%, that's 6. And if you had a return in bonds of 4, and that's 6. The idea is for every unit of risk you take, you deserve 1 unit of return. Historically, the stock market, for every unit of risk you've taken, has given you a 0.6. Remember I said the market over the last 100 years giving you 9? So for 68% volatility, that's like 0.5, 0.6. We won't visit an asset class or a manager unless we get a Sir Ratio over 1. Many of our clients have Sir Ratios over 2 or 3. In other words, for every unit of risk you take, you're getting 2 to 3 times that unit in return. That's how we run risk-adjusted portfolios. So we take, again, back to that 60-40 model that I commented on a minute ago. In 2022, a 60-40 model was down some 16%. Our families were all up.
Oh.
Okay? And so that's what we want to do. I will joke and say with my tongue in my cheek, we serve very demanding families. When the stock market is up, they expect to be up. And when the stock market is down, they expect to be up.
So just curious about this. You mentioned one fund manager that you're looking to back, but they're only on their second fund. Is that enough of a track record, given that, so much can happen within the first fund?
They had a 3-year track. Again, you're not looking at one kind of, let's call it a variable, right? You're looking at 20, 30, 40. They had a 3-year track record. Check that box. 2, they have a lot of skin in the game. Check that box. 3, they're looking at, and this is really important for venture capitalists or people who are starting, find something that needs a cure, something that needs help, okay? This particular fund is focused on health issues and biotech. The other fund is a general fund, but the GP of the other fund in the Silicon Valley, who's very, very connected with Y Combinator, if people know that group, and venture capitalists seek him out. So people starting a new business seek him out. And he looks at traits within that particular entrepreneur who says, here's a problem, and I think I can solve it. I want to use an analogy here for a second, and I'll digress for a minute. If you're an entrepreneur and you want to start a business because you think you have a solution to a problem, a cure for something, make sure it is not a better mousetrap. Never invest in a better mousetrap. And for those unfamiliar with this expression that's 100 years old, is the mousetrap that's still used today was invented 1,000 years ago. A little spring on a block of wood.
A little cheese on it.
with a little cheese on it, right? So never invest in a better mousetrap. If you think this is just a better mousetrap, come up with something else. Okay. Smart investors and venture capitalists will not invest in a better mousetrap. So look for a major problem. Okay. Something you can solve, something you can, make the world better for, something that has a moat around it, something with high margins, something that you could patent, okay, own the source codes for, and then you have half a shot of being successful.
That's very good advice. Obviously, that's what a lot of the most successful VCs I've learned from look at. Curious, what are some book recommendations you have?
So I have to admit, I wear hearing aids. Somewhat congenital, family issue, and I've been wearing hearing aids for about 15 years now. So where most people now have what's called earpods, I wear hearing aids. So you asked me about books that I've read. I don't read books anymore. I mean, I do the odd one, but I listen to books. And I'm embarrassed to say that in 2023, I listened to about a book a week, over 50 books. Last year, it was probably a book every 2 weeks. And I listen in my car. I listen while I walk. Sometimes I'll listen while on a bike or a treadmill. And I've become a bit obsessed by this. Now I'm a little OCD anyways. I've been in therapy for perfectionism, which is great when you're managing money and building, our family office. Relationships could be a little difficult sometimes, but I enjoy listening to books a lot. And I'll start with, I listened to a book because he's become such an enigma, a character, Elon Musk's book. Elon Musk's book written by Walter Isaacson, and which I thought fascinating. Now, whatever you say about the character, love him, hate him, and I think there's a dichotomy and so polarized that no one just kind of likes him. They either love him or hate him. But nonetheless, it's a great book, a great story, and he's brilliant beyond. Then I listened to Isaacson's book on Stephen Jobs, another of life's greatest characters, okay? And we can think about him every day because we use his products every day. And right now I'm listening to Isaacson's first book, which is on Benjamin Franklin, which I'm finding fascinating. Because
I read that as well.
Did you? I mean, people don't know that he invented daylight saving times and he invented the post office. Do you know in 1775, you could mail a letter in Boston and have it returned from New York within 3 days?
Better than today.
Stagecoach. It's better than today. Whatever, 175 years ago. But there are some business books and books that I believe that when I mentioned earlier this unquenchable thirst for knowledge, I would tell, and I did this in my early 40s when I started my business called Nisker Associates Strategic Wealth Management. I surrounded myself with wisdom. I had a board of directors with someone who has a library in Toronto named after him, and someone who started one of Canada's largest real estate companies, people who backed me and invested with me. And I never talk about clients. I have a lot of friends, but nonetheless, one of the things I learned, and in the next couple of weeks, if you're Jewish and celebrate Passover, Pesach, a famous person, Rabbi Ben Zoma, asked, who of them is wise? And the answer is so simplistic. It's he who surrounds themselves with wisdom, right? He of them is wise is surround yourself with people who know more than you. They've seen the movie before. They know the ending. And the idea is just learn from others. So that's the most important takeaway with building a business and learning from others. I want to mention Marcus Aurelius wrote an amazing book, obviously thousands of years ago, called Meditations. A Geometry of Wealth is a great book to read. Starting with Why by Simon Sinek is a very important read. Ask yourself first, why? When I write business plans, I talk about, what are we going to be? Where are we going and how are we going to get there? And people rephrase that to, a vision statement, a mission statement, and an operating statement, right? So when you're thinking about a business or investing in business, ask yourself those questions. Another, someone who's become a great author, and he's a multi-billionaire, but understand that he went bankrupt the first time he started, Bridgewater, Ray Dalio, wrote a book, Principles. And his most recent book is a fascinating read about the decline of empires. He went back 500 years, but he says there are 6 stages. The United States is in the 6th stage right now.
Fourth turning or that.
And empires end. And so Google Ray Dalio and read this last book. Psychology of Money by Morgan Housel. Everyone should read. It's a easy read. It's a short book, and it just so much common sense that we may bring him to Toronto, find out the last time he was here, who he spoke to. But he's a wonderful speaker. And lastly, The Wealth Money Can't Buy. Remember I said you can't take it with you? So living a life that's authentic, being a great communicator, helping others, being charitable. The Wealth Money Can't Buy is by Robin Sharma. The first book I read of his, because way back when, it was called The Monk Who Sold His Ferrari, okay, which is also a quick read, a nice little book, tiny bit spiritual, but quite impactful. So, that could be your spring or summer readings.
That's a lot of great suggestions. So lastly, this is my last question, I guess, is what is the best business advice you've received?
I'd say that in business, it's all about shared values, okay? Building something that's unique, being creative, being authentic, doing your research, okay? If you focus on the money, it's not going to come. If you focus on deliverables, doing something that's different, when I joked, I didn't joke. It wasn't a joke. When I said, honestly, I've been in therapy for perfectionism, my psychiatrist at the time convinced me, and I'm not going to tell you how much I spent on therapy, but let's say it's tens of thousands of dollars, that there's no such thing as the best. Everything in life can be improved upon. And I use the analogy that being the best isn't real. And the analogy is simply this. If you're standing looking west and you're at an ocean, okay, where the ocean meets the sky, what's that called? That line there, what's that called?
Horizon?
The horizon. Well, have you ever touched the horizon? How do you know it exists? So that's being the best. So there's no such thing as being the best. And by the way, if you ever for a moment thought you were the best at something, I guarantee hubris would set in and your world would start falling apart. So the idea is on the road to being the best. It is a goal. Let's call it an elusive goal, but it's a goal. But on the road to being the best, be different. Mm-hmm. So what are you doing in life to differentiate yourself in business? How is that business different? You want it to be the best, but how is it different? How big is the market? Okay. And what I talked earlier about, is there a moat around it? But when you have employees, okay, we hire employees that have a higher EQ than IQ. It's important that they're, empathetic. It's important they understand the families. It's important they communicate. Now, obviously, we want them to have a high IQ as well and a lot of experience. But it's the same thing in business. I call it shared values. What are your values? Write them down. Do a values exercise. Write down 15 values. And then what are your top 5? And then who do you want to be partner with? Because no one does it alone. I've commented that I've helped to build 3 businesses. This is my 4th. Did nothing on my own. I always surround myself with great people, okay, with different skill sets, and people who help me look good. And so that's my advice for starting a business. Understand the risk you're taking, and find something you're passionate about. One last comment. I've been so fortunate in life. I've been blessed because I've had 2 passions in life that on one I've been able to earn a great income from and lifestyle, and the other I've been able to fulfill my other passion, and that is be charitable and give money away and help organizations, charities, not-for-profits. In life, very few people are blessed that they can earn income from their passions. For example, it's very difficult to make an income as a poet, as a songwriter, as a musician, as an artist, as a chess player, okay, as a golfer, as an athlete. Very difficult. Those passions become your hobbies. You're still passionate about it. I would say a key to life would be, and I'm not just going to say work out every day, eat healthy, make sure you focus on sleep, have a lot of friends, and find someone you could love and give your love to and have that reciprocated. But I do believe that if you can be passionate about a business and earn income from it, you've made it. You have it all. That's all there is in life.
Wow. That's some great words of wisdom. Thank you, Mr. Nisker. This has been very insightful.
Neil.
Thank you, Neil. For those curious, we'll leave some links down to some content that Neil produces, maybe more information about our family office. And if you like this type of content, please leave a like, comment down below, let us know what you think, and we'll see you in the next one.